Buffett, the Oracle of Omaha, has outperformed Wall Street for over half a century. How does he choose the stocks that build generational wealth while most investors get trapped in short-term thinking? In today's video, we're breaking down Warren Buffett's legendary investment strategy, how he picks winning stocks, and how you can apply the same principles. Number 1, invest in what you understand. This is what he calls staying within your circle of competence. It means that if you don't clearly understand how a company makes money, who its customers are, and why people keep buying from it, then it's probably not the right stock for you. In the late 1980s, he began buying Coca-Cola shares, not because he had some secret financial model, but because he simply understood the business. He saw the power of its brand, the simplicity of its product, and its global presence. Buffett often said he could see Coca-Cola's dominance every time he walked through a grocery store or sat in an airport. There were no confusing products, no elaborate strategies, just a universally loved beverage with strong brand loyalty and global distribution. That clarity gave him confidence, and he held on to Coca-Cola for over 30 years. Today, that investment generates hundreds of millions of dollars a year in dividends alone. By contrast, Buffett stayed away from tech stocks for most of his career, not because they weren't valuable, but because he didn't fully understand them. He famously passed on early investments in companies like Amazon and Google, even though they became giants. It wasn't until later, when he better understood how a company like Apple generated customer loyalty and recurring revenue, that he made his now famous multi-billion-dollar investment. Number 2, the power of the moat. A moat might be a powerful brand, massive scale, patents, network effects, or even just customer loyalty built over decades. These are the invisible shields that let a company dominate year after year, even as others try to compete. Let's take Apple, for example. Buffett shocked many when he started buying Apple stock in 2016, especially after years of avoiding tech. But he didn't see Apple as a tech company. He saw it as a consumer product company with a world-class moat. The iPhone wasn't just a phone. It was part of an entire ecosystem. Once you use an iPhone, you're likely using AirPods, iCloud, Apple Pay, a MacBook, maybe even an Apple Watch. And because everything works so seamlessly together, users don't just like Apple, they stick with it. That's the moat. Buffett believes that over time, a wide moat allows a business to fend off competition, maintain pricing power, and compound profits. On the other hand, a business with a wide moat can survive wars, recessions, new technologies, and still thrive. Number 3, look for consistent earnings. To Buffett, a company that can reliably make money year after year, regardless of market conditions, is far more attractive than one with flashy growth but unpredictable profits. Buffett doesn't want to guess what a business might earn next year. He wants to know with a high level of confidence. That's because predictable earnings allow for better long-term planning, stronger compounding, and fewer unpleasant surprises. If a company's profits swing wildly from quarter to quarter, it's not a business, it's a gamble. Take Procter & Gamble as an example. It's not a tech startup or a trendy stock, but it's one of Buffett's longtime favorites. P&G sells everyday essentials like toothpaste, shampoo, and laundry detergent. People buy them whether the economy is booming or in a downturn. That means cash flow is steady, earnings are consistent, and the business can reinvest in itself year after year. Buffett often compares investing to owning a farm. You don't check the price of your farm every day. You care about how much corn it grows each season. It's the same with stocks. He's less concerned with stock price volatility and more focused on how much money the company actually generates over time. That's why he prioritizes earnings over hype. This philosophy also explains why Buffett largely avoids industries like airlines or oil, despite them occasionally offering high returns. These sectors tend to be cyclical, meaning their profits rise and fall based on external factors like commodity prices, interest rates, or geopolitics. Buffett has said he wants businesses that are so stable, an idiot could run them, because someday, one probably will. Number 4, strong management. To Buffett, great management isn't just about operational efficiency. It's about trust, integrity, and capital allocation. He believes that even the best business models can be destroyed by poor leadership. That's why, before buying any stock, Buffett asks himself, do I trust the people in charge to make the right decisions for the long term? He looks for managers who are not only skilled operators, but also think like owners. Those who prioritize shareholder value and allocate profits wisely, rather than chasing headlines or short-term gains. Buffett doesn't interfere with his portfolio companies, but he keeps a close eye on the judgment and discipline of their executives. He famously said, "When a management team with a reputation for brilliance tackles a business with a reputation for bad economics, it's the reputation of the business that remains intact." In other words, great management can't save a bad business, but bad management can ruin a good one. Take his investment in 𝐬𝐫𝐸𝐶O, for example. When Buffett first invested, he wasn't just impressed by the company's low-cost model. He was sold on the leadership of Tony Nicely, who steered the company with discipline and long-term vision. Or look at his hands-off approach with Apple. Buffett consistently praises Tim Cook for his exceptional capital management, from product innovation to strategic buybacks that have increased shareholder value. Number 5, value greater than price. Buffett doesn't ask, "Is this stock going up?" He asks, "Is this company worth more than what I'm paying for it today?" That simple question is the foundation of Buffett's legendary success. Because price is just what you see on a screen, but value, that's what you actually get. He is a value investor at his core. He's not interested in buying cheap stocks. He's looking for undervalued businesses with strong long-term earning power. He wants to know, if I own this company for the next 10 years, will it generate more cash than I'm paying for it now? If the answer is yes, and the business is strong, stable, and well-managed, he's ready to invest. To estimate a company's intrinsic value, Buffett often uses a method called discounted cash flow, or DCF. It's not about complicated formulas. It's about common sense. He estimates the company's future profits, then calculates what those profits are worth today. If the stock is trading below that estimated value, he sees it as an opportunity. But here's the secret. He's incredibly patient. He's willing to sit on billions in cash and wait until the market offers him a bargain. In 2008, when the financial world was collapsing, Buffett invested $5 billion into Goldman Sachs. While others were panicking, he saw a moment of fear, not failure. He structured the deal with preferred shares and high-interest returns, and when the market recovered, Berkshire Hathaway walked away with billions in profit. That wasn't luck, that was value investing. Buffett style. He once said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." That's how he views value. When great businesses go on sale, that's when you go big. Number 6, long-term mindset. While the world obsesses over headlines, Fed meetings, or quarterly earnings, Buffett plays a completely different game. His favorite holding period? As he famously says, forever. Buffett doesn't buy stocks. He buys businesses, and he only chooses ones that he'd be comfortable owning for 10, 20, even 50 years. He ignores short-term market swings because he knows that time is the friend of a great business. Buffett understands the power of compounding. Letting your investments grow uninterrupted over decades is how real wealth is built. He isn't interested in quick wins or flipping stocks like a day trader. In fact, he once joked, "If I were given a punch card with only 20 punches, meaning I could only make 20 investments in my life, I would become incredibly selective, and I would be a much better investor." If you're constantly jumping in and out of the market, chasing trends, or trying to time the perfect entry and exit, you're not playing Buffett's game. To win like him, you have to think in years, not days. Buffett's strategy isn't built on complexity or speed. It's built on clarity, conviction, and patience. In a world chasing quick wins, he quietly builds empires, one smart decision at a time.